Awesome. Hello, everyone. Thank you again for attending the Cost of Credit. We are Nevada Money Mentors. This is our final event for the summer series. My name is Amy Nelson. I am the Financial Wellness Coordinator on campus and help manage the Nevada Money Mentor program. If you haven't heard of Nevada Money Mentors before, we are an on-campus resource that helps you with all money-related activities, questions, concerns, and things that you have. When we get back on campus this fall, you will see us around campus at different tabling events and workshops. You will also catch us in your classes, and then we hope to do in-person, if at all possible, presentations this fall as well. One of our most popular services, as mentioned in previous calls, is called financial coaching. We really hope that you, as a student, will take advantage of that service. It's a one-on-one with a peer mentor. You can chat about money goals that you have and how we can help you get on track to those goals. It's a little bit of a process. We meet with you 3 to 4 times in a semester, but a process that totally works, and we can help you get onto your money goals. So today we have Devin Cooley, who is one of our peer mentors within the Office of Nevada Money Mentors. He is a finance major through the College of Business and very excited to bring to you the cost of credit. We know a lot of students are either interested in getting their first credit card or borrowing student loans to help pay for school, but don't always understand what is that truly costing you. So Devin's going to cover all of that for us today and give us some case studies. Feel free to ask questions during the chat, use the chat box, and we will answer them as he's discussing. So Devin, go ahead and take it away.
Thank you, Amy. Yeah, we'll hop right into it then. Okay, so we're going to talk about the types of credit. But before we start talking about the types of credit, let's think about what credit really is. So the definition of credit is the ability of a customer to obtain goods or services before payment, based on the trust that the payment will be made at a future date. Okay, so what the types of credit are depend on certain criterias, like how the funds are getting there, when they're needed, how much you're paying. And so the first one is probably one that you're familiar with. So installment, that's what it's called. These are student loans, car loans, and home mortgage loans. They have regular payments that is a fixed amount over a specific time. So this is a huge debt for Americans, especially student loans, and it's just continuing to increase. But things like car loans and home mortgage loans go by the same basic routine of payments. And then after this one is probably one that you might be using right now, and maybe it's the first thing you think about when you think of credit, and that is revolving credit. So this involves your credit cards, home equity line of credit, and department store cards, like getting stuff at I don't know, H&M, like if they give out those cards. And the real difference between these two is that it's an extended credit up to a limit, free to use repeatedly, but as long as you pay responsibly. So everyone knows you have a credit limit, right? Let's say it's $1,500. You're allowed to spend up to that limit, not anymore, but it's kind of the payments differing because how much you spend on that card changes each month, but it's just revolving over and over again. And it's free to use. And if it's free to use, really, we'll see in the fees section of this presentation. But another one that you might not even think is a type of credit and that's called open. So this involves your gas, water, and electric. And you could already see right now how different it is from the others. It's just because you get a certain ability, like you get your gas, you get your water, and you get to use that prior to you even paying. And you have to pay in full, and it varies each month. Obviously, you don't use the same water each month and the same electricity, but it's still a credit that's accustomed to you. So how many lines of credit do you guys have? I think after seeing these different types, you might have realized that you have more than you might have guessed. And that's okay. As long as you're doing things responsibly and taking out the right amount, there shouldn't be any problem with you getting lines of credit, okay? But there's a lot of different things that go into credit, right? And one of the biggest things is interest rates. So let's think of the definition of interest. And that's a portion of your loan that is charged in addition to the principal. And that's the initial amount you borrowed. And that typically is represented by an annual percent or rate. So have you guys ever heard of APR? It stands for annual percentage rate. And it's very important that you know what that is on any type of loan or line of credit that you're receiving, because you'll see how much it makes a difference to how much you end up paying. Okay. So interest can be two different things. It could be simple interest, and that's interest applied to the principal, right? The initial amount you borrowed, uh, or compounding interest. So that's interest that is charged on top of interest. So if you ever heard of the phrase growing through compound interest, or it's compounding, that means it's growing exponentially on top of the interest that you're already getting, because that's a very slippery slope that you might face. So let's look at these numbers, and I want you to keep in mind when you're going through this that these numbers are based off zero payments and are only to illustrate the impact that a simple interest rate and a compounding interest rate could do to your loan. So let's start off with a car loan. So this is simple, right? So like I said, the interest only applies to the principal. So for a $10,000 car loan, that's going over 5 years at the average 8.06%, that'll end up giving you $4,030 in interest. Okay. So you'll end up paying $14,030. Um, and so you could see a big difference in this. So all car loans are simple, but on top of that, all credit cards are compounded. So with $10,000 worth of student or $10,000 worth of credit card debt, which is a lot of credit card debt, and let's say you have a 5-year plan to pay that off at 19%, you'll end up paying $15,850 in interest. See, that's a massive amount of change, and that's a combination of the higher interest rate, basically over double that of the car loan, but also how it just compounds daily. It's just 3 times the amount of what the car loan would be. Now let's meet somewhere in the middle with a lower interest rate, but still compounded, and that would be a student loan. So you guys may have student loans right now. And if you were to make no payments on that for a 10K student loan over 5 years at, let's say, 4.66%, that's the APR that we were talking about, right? You would end up paying $2,623 in interest. So you could just see the massive change that compounding and simple could really make. Because even though the car loan has basically double the amount the APR that the student loan has, it's practically 3/4 of the way there in interest. Okay, so you have to think about that when you're opening a line of credit, the APR, and you have to think of when is it going to be compounded, because you can see right here how much of a difference that really makes in the end of it. Okay, so without further ado, we'll go into any additional costs. Now, these are very important because some of these are very avoidable, and you want to know everything about the line of credit that you're opening before you open it, right? So it'll really show you the true cost of credit after you're looking at the different fees and penalties that you might be charged with. So origination fees, late fees, annual fees, foreign transaction fees, prepayment fees. It goes on and on. And most of these are from credit cards, and they could really get you with those fees. But that doesn't say that, late fees are obviously attributed to any loan, and defaulting on any loan will cause you problems in the long run. So if you know you're facing any fees, just really know what you're going to do, and try to avoid it at all costs, because you don't need any more of a burden on your hands when you're trying to pay back your loan. So have you guys ever been charged any fees? Go ahead down and put it in the chat. Or if you want to talk about, how much lines of credit you have, go ahead and say that too. I honestly didn't even realize how much lines of credit I did have until really going into the details on what is credit. Oh, sorry about that. we'll just go back. Oops. Sorry, we're gonna go back. We just missed a little slide. Yeah, so Amy, good pointing out the cash advance fee is terrible. Yeah, student loans, obviously in all caps, that's a big one. That's one of the biggest debts in America right now. So we could all relate to that pain, and we all kind of just want to do our best to pay it back. And we'll see how those numbers break down in a second. Okay. So everyone hears what the impacts of bad credit is, right? Everyone sees the ads where it's like, my credit score went up 17 points. Thank you, blah, blah, blah. But people want to raise it for a good reason, because impacts of bad credit could reach everywhere in your life. And you don't want to be caught in the middle of having a bad credit and trying to, do the things that we're about to talk about. So the number one thing about having a bad credit score is it impacts your ability to obtain different lines of credit. Okay, so it's going to be harder to get a new credit card. It's going to be harder to get a car loan, just because the credit score, it shows how good you are at making payments, how responsible you are with your money. So why would these lenders give to someone with such a poor score? Because they think you're going to default on the payment and they're not going to get their money. And even if you do get a line of credit, the interest rate on that, the APR, will be much higher than someone who has a 700, 750 credit score, which is much better than a 360 to 580 credit score. But not only that, so just like it'd be hard to find a mortgage, opening that different type of credit, it's hard to find a place to rent out, because commercial and private renters will look at your credit score, and that'll really dictate if you're really going to be able to pay them the money that they need for you to rent it out. So if you have a bad credit score, you might be having a hard time trying to find any place to even keep you there. So that's why it's really important, because shelter's one of the biggest things you need in life, and you don't want that to be impacted by your credit score. And second to last, you might be paying more for utilities and insurances. Some states, it's allowed for insurance companies to look into your credit score and find the link between, you getting an accident, you being responsible, and your credit score. So you'll be paying higher premiums for your insurance if you have a bad score. And this goes for utilities too. They'll make you pay more if you feel like they're not going to get paid back. And obviously we learned that utilities are actually a line of credit. So they're very much influenced. Lastly, obtaining a job. You might think, like, why would places care what my credit score is? And it does make a big impact for those that have to handle money. Like, just like my mom, she's a teacher. She has a card that she could charge the school for, because she needs certain supplies. If the school knew, hey, my mom doesn't have a bad credit score, I don't believe, but if she had a very bad credit score, they're like, why would we give you the keys to this car if we think you're going to crash it and we're going to be ending up paying a lot of money? So that's something you got to think about when making purchases, if this is going to really influence your credit score, because it can influence your job in the long run. All right, now, just like Amy said, we're going to go over some cases of different lines of credit going to different people. So first, we will talk about a massage therapist, okay? And what we're going to be doing through these exercises is seeing people with different lines of credit, different amounts, different rates, different salaries, and how much they'll end up paying within the history of their credit, because everybody's different. In this case, nobody's going to be making the same exact amount. No one's going to be paying the same amount. So let's look at these different cases, starting with the massage therapist. So we have the median salary in Nevada for a massage therapist is $51,857. Okay, so keep that in mind when we're going through these different credits. So this specific massage therapist doesn't do very well with credit. They have actually the household annual credit card debt is $6,849, and they're doing that all by themselves at a 19% rate. And then secondly, this massage therapist wanted to be a nurse, right? The average debt for a nurse is $47,321 at the average of 3.9%, which is the average for UNR. And that's based off studentaid.gov. Go check that place out. It'll give you a good simulation on how much you'll be paying or your different payment options for your student loans. So let's see how much she'll be, or she or he will be end up paying in the long run. So for the 5-year credit card plan, she or he will have a monthly payment of $172. Okay. And the interest paid on that is $3,485. So that's a massive amount of just interest paid based off the compounding nature of credit cards at a high rate and such a high principal. And so the total paid would be $10,334. So think about that. A third of what they paid in total, they didn't even get anything for. They're just paying interest on that. So the $6,000 worth of stuff, they had to pay that, but on top of it, they had to pay another $3,485. Okay. And now let's take a standard 10-year student loan plan for this $47,321 student loan. So she'll be making a monthly payment of $477 each month for 10 years. And the interest paid on that will end up being $9,902 with a total payment of $57,223. So that's, half $100,000 just going straight to student loans, which is a lot. And I think the more important thing is the $477 payment each month on top of the credit card. That's a lot to be paying each month. That's a big percentage of this massage therapist's monthly income. That's going straight to the debts that she had from something that happened a while ago. But let's look at a different case, a more average case, you could say. And that's one of the teacher. So again, the Nevada median salary for a teacher is $59,632. That's, a pretty good amount. And definitely looking at her student debt, which is the average for UNR based off, studentaid.gov, which is $19,500 at 3.9%. And let's say this teacher, she wanted a used car, right? And she took out a $20,000, $446 car loan at the average car loan rate of 8.06%. These are obviously less debts in total than our massage therapist went through, but let's see how it impacts her monthly spending. So with a 5-year plan on a car loan, she has a monthly payment of $197, and she'll end up paying $4,080 of interest on that car loan. So in total for that car, she'll be paying $24,526, which is very doable with her salary. The monthly payment on that is pretty good. Definitely for a car that she's hopefully going to use every day to get to work. But let's look at the student loan. Okay, obviously no, student loans are a big problem, but let's see how she's handling them. So she has a monthly payment of $352. Okay, and the interest is only $2,080 after that 10 years. So she'll end up paying only $21,580. So you could see for her, student loans were much less of a problem because she didn't have such a big principal, even though they had the same 10-year plan at the same rate. The principal was so high that it influenced the massage therapist's final score or final total paid. But now let's go from an average. Oh, we have a question. For student loans, you get have the option for subsidized and unsubsidized loans. What is the difference between both of them, and how are the payments different between the two? That's a great question, Nyla. Hopefully I'm pronouncing that right. So the difference between subsidized and unsubsidized is basically the grace period. So for a subsidized loan, that means that during your school tenure, you'll be incurring no interest at all. The federal government will cover that until 6 months after you graduate. So you don't have to make any payments, or you won't get any interest on a subsidized loan until 6 months after you graduate. An unsubsidized loan differs because it will incur interest while you're in school. So if you have, let's say, $10,000 of unsubsidized right now, you'll be getting whatever your APR is for that. You'll be getting that forever, but you won't have to make payments on it till 6 months after you graduate. Does that clear things up for that? The payments are still the same. It's just the grace period and when interest starts accruing. Okay, thank you. I'm glad to hear that I pronounced your name right. So speaking of student loans, right? Let's talk about someone that will have a lot of student loans, and that's someone that's going to med school. So if any of you have aspirations to go to med school, think about this. For a family physician, right, a median income in Nevada is $211,368, which is, a lot of money, but, a lot of money might mean bigger tastes. So this specific family physician decided to finance a car for $78,695 at the rate of 5.48% annually. So that's a really, really nice car, but he's like, hey, I'm gonna be a physician. So I'm just gonna get this nice car and worry about it later. And not only that, but he has, the average med school student loan of $232,300 at 3.9%. We're just gonna keep that consistent. But he does a little bit better on credit cards than the massage therapist does. He only has $3,424 worth of credit card debt, and that's about half of what the massage therapist had at the same rate. So this is going to be a lot of numbers, but bear with me, okay? So the 5-year car plan, they'll have a monthly payment of $1,502 with the interest coming out to $11,451. That's a total paid of $90,000 and $146, or $90,146. That's a lot. $1,502 is a lot to pay on any car or anything in general. But he's making a comfortable living, so you have to spend your money where you value it. And if he values cars, then you have to work around that in your budget. But he can't escape his loans. So he has a 10-year plan, like everyone else we mentioned, but his monthly payments are $2,000 or $2,253, okay? Another massive amount to be paying each month. With the interest coming out to $38,082. Sorry, I'm starting over all the numbers. And the total paid coming out to $270,382. So you could see, just like the massage therapist, the massive amount that he took out for the principal really came back to somewhat bite him. Sometimes it's necessary to take out student loans, and you shouldn't be afraid to do that, but you got to make sure that you're taking out the right amount. So he's ending up paying $38,000 on top of the $232,000 that he initially taken out. And finally, let's look at his credit card. So his monthly payments are only $149 each month for his 5-year plan, having that interest come out to $783 and a total paid of $4,207. So you notice that this family physician used his credit card a little bit more wisely than a massage therapist. And we actually took that into consideration when thinking about the interest rate he got on his car loan. See, while the other car that was bought by the teacher was at 8%, he only paid 5.48% on his car loan. So you could see that, that kind of influences everything. You get a good credit score, your rates might go down a little bit. And now let's do a little debrief. We take a deep breath, right? It was a lot of numbers, but let's see what you really need to take from this, okay? Now you know the true costs of lines of credit. But before you even do that, before you take out any line of credit, you have to think about, am I borrowing what I need? You have to do the math and figure out, is this really the amount of money I need? Because if you take out any extra, it could come back to bite you. And plan for fees or plan to avoid fees. Okay. You don't want to be charged anything more than you have to do. And something that we didn't quite talk about as much is liquidity. So what liquidity means, um, it's basically about the flow of cash that comes in and out. Are you able to spend money on things like uh, emergencies or freeing up cash to pay someone? Because if your money's locked up in all these debts, what money do you have to spend on, your groceries? You have to do the math to figure out, am I going to be locking myself up with these loans that are going to keep me from making the purchases that I need to make? And then finally, do the math, and is it worth it? So you have to do the math for all of these, problems, even though how annoying it might be. You really need to know how much you're going to be ending up paying and decide, is it worth it? Is how much I'm taking out worth it in the long run, and how much it's going to impact my wallet. So now let's bring it back to Amy for any questions, and we'll just stay on the line. And you could just put them down in the chat. Amy, are you there?
Yeah, thanks, Devin. Great job. Really interesting. It's amazing how expensive it can be when it all adds up, right? But then you look at sometimes you're investing in your education, and if you've got the plan to pay it off, then that's what you need is the plan. So it looks like we have a question that came in, Devin. Does it hurt your credit to refinance? When can you refinance, say for a student or a car loan? Does it hurt your credit if you pay off a car loan or student loans too quickly? Good question. So it can, I wouldn't necessarily say it always hurts your credit, but when you're pulling information to apply for new credit, such as a car loan or a new credit card, it can be what they call a hard hit to your credit. So it may drop your credit score a few points. But over time, as you make payments on time for that credit card or car loan, your credit score will continue to increase, because one of the biggest things that impacts your credit score is making payments on time. So it doesn't necessarily hurt your credit if you pay off a car or student loans too quickly. It can maybe show if you close down those accounts, of course, afterwards, then you don't have as many credit lines open. So it can have a negative impact for a short period of time on your credit as a whole. But I think what you want to outweigh there is how much are you saving because you paid it off faster? And what you're saving, does that outweigh the importance of quickly improving your credit score? In most cases, it's better to save the money in your own pocket and pay it off sooner if you can, than worry about what it will do to your credit score. But there are some strategies in there too, Dylan. It can get a little complicated depending on if you're looking at making a bigger purchase and you want things to be reported to your credit more regularly. There's strategy to that. But for the most part, I would say it's best if you just pay them down faster and make sure you're making those payments on time.
And
Devin, did you want to add anything to that?
oh yeah. To Dylan's point, and I agree, 100% with all you said. You do want to look at prepayment penalties, like we said in the fee selection, that some cars might have a prepayment penalty, and also just the money that you have on hand. I remember, a little story is when I first got my student loans, I kind of was like freaking out, just like any young kid is. You're so young getting them, and I was like, you know what, I'm just gonna start. I paid a bunch of money that I probably should have saved because I needed it like a month from then, and I just kind of thought like, oh, I'm gonna pay that down this money. It's going to save me a lot of time, but it actually hurt me in the long run because I needed that money. So as far as cash flow, you want to make sure you have enough money on hand for emergencies, and not just go paying off loans willy-nilly, because that might hurt you in some other aspects of your life.
Yeah, good point. And I totally forgot about prepayment penalties. So make sure you look at your loan. And again, just it's individualized, right? Everyone has to kind of look at their own situation and see what the best option for you would be. So good question, though. Allison asked, what is the difference of the secured and an unsecured credit card? Devin, I can answer that one. A secured credit means that it's tied to some form of collateral. So, for example, secured credit could be like a mortgage loan as an example of secured credit because it's tied to the value of the home. You can look at secured credit cards, though, when you're just talking about credit cards, where you would open up, say, a small savings account with your bank, maybe of $300 to $500, and then you use the money that you've deposited to as your credit line, and then you pay yourself back. So it's a way for you to build credit, a really great way for you to build credit if you don't have any, because what you're doing is just showing the bank that you're responsible and can make those payments back. An unsecured line of credit or credit card is not secured to any type of collateral. So basically, when you apply for an unsecured credit card, those are your major cards, the Visas and stuff like that, typically, that you would be approved for a specific limit on the card or line of credit. So let's say you get $1,000 on that card, but that $1,000 is not tied to the savings account that you've opened. It's just money that you're borrowing from the creditor, and you're responsible for paying that back. So Devin, if you want to add anything to that one.
Yeah, well, just the whole secured and unsecured credit, you think of it like, student loans are, I would say unsecured because you are, they can't take your information away from you. So you could think of, some things like, a car, that's the collateral. But as far as your education goes, they can never take that away from you. It's kind of just a nice thing to add because student loans are pretty daunting. So you get what you get, and that's why you need to make the most out of college.
Yeah, it's a great investment. So they can't take your education away. But if you stop paying on your car loan, guess what? They're going to come repossess your car. So different way to look at it. So awesome. And then Kevin says, would you get more credit if you pay off the amount in one lump sum or if you pay it monthly? I wanted to pay off my subsidized loan by the end of student loan deferment, but I wasn't sure if I should pay monthly or in one lump sum. So Devin, do you want to take that or do you want me to?
Yeah, I'll just say I don't believe that during the grace period for a subsidized loan, I don't think that it doesn't hurt you if you don't make payments before that deferment. And so I don't really think it makes a difference as far as your credit goes. Correct me if I'm wrong, Amy.
Yeah, the only thing that comes to mind to me would be the way the information is reported. So remember, there's a lot of gray area in credit in general and with the credit reporting. But if you are making payments monthly, chances are you could be showing on your report then that your balance is going down and that you're making payments on time or making payments at all, because they know on your credit report, you'll see monthly your payments made and if those payments were made on time. So I'm wondering that if you were to make payments throughout deferment, if they would be reported, and then if that reporting shows, it would help your score. But I'm not entirely sure. It depends on the strategy there. And again, if you've got the extra money, if you paid it in lump sum, are you still okay for an emergency situation? Do you have savings built? So it could go a little bit deeper than that. But there is different ways that it's reported. And unfortunately, I don't have a standard like way of saying, yes, they report every 30 days or every 15 days. It can vary depending on the credit agency as well as the creditor. So I hope that helps a little bit. And then Nyla says, when I turned 18, my mom put me on her credit card to help build my credit, but I have no knowledge of the payments or anything like that. So should I close that credit and open my own since I have no knowledge of what went on behind the scenes? Yeah, so one good thing would be that mom put the credit in your name to hopefully help you build it and get something established for you. And one of the other pieces of the pie in building your credit score includes credit history. So if you've got a card that's got a good length of history, it's best to keep those cards open. But what I would do is go back and inquire and see if your Are you on that card together? You know, what would be the benefits of keeping that card? What would be the benefits and or risks of closing that card, and see if you could get one in your own name. So I would do a little bit more research on that to decide if it's a card that you do want to keep because of the history piece on it, or if it is worth closing it. One way you could find out a little bit more is just pulling your credit report. Anybody can pull your credit report by going to annualcreditreport.com. Anything else? Okay, so Dylan has one more question. Can you trade in a car for a cheaper car to eliminate a car loan so you can focus on student loans? Say an APR is 12%, you roll over 100 of credit card month amount in the next one. Gosh, good questions, Dylan. I think you would be a perfect candidate for financial coaching because what we can do during that is really break down those numbers. I don't know if this is a hypothetical question or if it is something that you're really interested in doing, but it might be worth it sometimes, yeah, if you can kind of, you know, refinance, if you will, or find out a way to lower any of your monthly payments on other credit cards. We've got some really great tools and calculators we can show you during coaching sessions to see if it would be beneficial and save you in the long run. Great questions, you guys. Credit is a complicated world, but an important piece of your financial world. And so we are so glad that we were able to share this information with you today. As mentioned, feel free to reach out to us. We are happy to customize your financial goals and get you on track to achieving those goals. So reach out to us, visit our website anytime. We hope to see you on campus real soon. And if not, we'll be sure to host some more workshops in the fall, and we'll see you then. Thanks, everyone.
Yeah. And Dylan